Welcome back to the Rock and Turner Investment Podcast. We're excited to have you join us for another episode filled with valuable insights and expert analysis to help shape all of your investment decisions.
Before we begin, please note the following legal disclaimer. The views and opinions shared in this podcast are intended for entertainment purposes only. Any references to regions, countries, sectors, stocks, securities, or other assets are for discussion purposes and should not be considered as recommendations to buy, sell, or pursue any specific investment strategy. This content does not constitute accounting, legal, tax, or investment advice and should not be relied upon as such. The material may include forward-looking statements, forecasts, or projections, which are inherently uncertain and not guarantees of future results. There is no assurance that any predictions or projections will materialize. All data referenced in this podcast has been sourced by us and is provided without warranties of any kind. The data may contain errors and should be independently verified before use. Neither we nor the data providers accept liability for any reliance placed on the information presented. Always conduct your own research, seek professional advice, and take responsibility for your investment decisions.
This is James Emanuel, and today we're talking about investing in long-term value creators, programmatic acquirers, acquisition as a business. Now, there's a great growth paradox. Here's a sobering truth that keeps CEOs awake at night. Sustaining organic growth meaningfully above inflation at double-digit rates for decades is almost impossible. Think about it. How many businesses can you name that have genuinely pulled this off? The list is surprisingly short, which explains why companies collectively spend more on M&A than any other capital allocation strategy. But here's where it gets interesting and a bit tragic. Despite all the fanfare around compounders that grow through acquisitions, study after study shows that most M&A deals actually destroy shareholder value. The Hall of Fame for M&A disasters reads like a corporate tragedy anthology. Remember when Microsoft bought Nokia for $7.2 billion in 2014? That's widely considered one of the worst acquisitions ever made. Microsoft not only failed to crack the smartphone market, but had to lay off about 18,000 people and write off billions in the process. Then there's the Google acquisition of Motorola Mobility in 2012. It paid $12.5 billion, only to sell it on to Lenovo for under $3 billion just 2 years later. That's 75% of the acquisition cost, $9.5 billion of shareholder capital wiped out. The carnage doesn't stop there. We've witnessed epic failures like the attempted Kraft-Heinz Unilever merger, the messy Citicorp Travelers combination, AT&T's troubled Time Warner adventure, Bank of America's disastrous Countrywide acquisition, eBay's puzzling Skype purchase, the legendary AOL Time Warner disaster, the ill-fated Daimler-Chrysler marriage, the Kmart-Sears combination that satisfied no one, and FedEx's problematic TNT Express deal, which has been going on for about a decade. Each represents billions in destroyed value and countless strategic missteps. The numbers are stark. Harvard Business Review analysed 2,500 acquisitions and found that over 60% destroyed shareholder value. The usual suspects behind these failures: paying ridiculous prices, wildly optimistic synergy assumptions, rushed due diligence, botched integration, or simply deals that made no strategic sense beyond feeding a CEO's ego. So why does everyone keep doing M&A? Given these terrible odds, you might wonder why M&A remains so popular. The answer is surprisingly human. There's something undeniably seductive about mergers and acquisitions. They promise shortcuts to scale and market dominance that feel far more exciting than the mundane work of improving operations day by day. Think about it from a CEO's perspective. Announcing a major acquisition generates headlines, analyst attention, and often a temporary stock price bump. Compare that to the thankless task of optimizing supply chains or improving customer service processes. Which sounds more glamorous to you? Then there are the perverse incentives that make this problem worse. Many executives get paid primarily for growth, not value creation. They're rewarded for getting bigger, not necessarily better. And here's something most people don't fully appreciate. The choice of financing, cash, debt, or equity, fundamentally changes the entire risk-reward equation of any deal. Use debt and you amplify both success and failure. Yet this crucial detail often gets glossed over in the excitement of deal making. So let's look at when acquisitions actually work. Despite all the carnage, acquisitions can work brilliantly when done right. They open doors to new markets, expand geographic reach, add product lines, and create genuine competitive advantages. More importantly, they can establish platforms for the next wave of organic growth. Amazon is the poster child for acquisitive success. Starting as a humble online bookstore, It's made well over 100 acquisitions across virtually every sector you can imagine. This relentless strategic expansion has been absolutely crucial to Amazon's evolution into the everything store we know today. The contrast with eBay tells a fascinating story. eBay was actually more dominant than Amazon in early e-commerce, but failed to adapt and evolve. Ironically, eBay's most valuable strategic move was acquiring PayPal in 2002. When they spun it off in 2015, 13 years later, PayPal's market cap eventually exceeded eBay's core business. One smart acquisition created more value than decades of marketplace operations. This shows us something important. When done properly, inorganic growth can be incredibly powerful. The question is, what separates the winners from the disasters? Not all acquirers are created equal. Here's where things get really interesting. There are fundamentally different types of acquirers, and understanding these differences is crucial if you want to invest in this space successfully. The acquirers who tend to succeed are those who do M&A frequently, get really good at it, and constantly improve their process. But even among these experts, there are important distinctions. First are the speculative acquirers. These are typically the private equity firms. They see acquisition targets as speculative short-term assets. Their game is all about buying, restructuring, slashing costs, asset stripping, loading with debt, performing some form of accounting alchemy, and then seeking to resell at a profit within 3 to 5 years before the irreparable damage that they've caused to the underlying business becomes evident. The second subset are known as serial acquirers, entrepreneurs who grow by consolidating companies in the same industry, essentially rolling up competitors to gain market share and to benefit from economies of scale. Critically, this requires post-acquisition integration, which is the trickiest part of the process and the most common cause of failure. Essentially, for serial acquirers, M&A is a means of enhancing the underlying business, whatever that may be. While this strategy can work well, very few pull it off successfully. Brad Jacobs is perhaps the rare exception, having executed this playbook perfectly 4 separate times, creating multiple billion-dollar businesses from scratch. For most serial acquirers, though, there's a dangerous tendency to rush. They feel pressure to keep acquiring because they're operating in narrow markets with limited targets. This urgency usually leads to mistakes, making serial acquisition an extremely high-risk speculative strategy. So that's what we mean by a serial acquirer. Then there's a rare breed of company that completely flips the script. These are what we call the programmatic acquirers. For these exceptional companies, acquisitions aren't gambling, they're craftsmanship. They've transformed the high-stakes world of M&A into a repeatable, value-generating system that they execute almost with surgical precision. Here's what makes them different. They don't use M&A to grab market share or grow by consolidating competitors. For programmatic acquirers, acquisition isn't about enhancing an underlying business. Instead, acquisition is the business. You'll be familiar with the acronym SaaS, or Software as a Service. Well, I refer to programmatic acquirers as AaaB, Acquisition as a Business. They're specializing in finding overlooked, high-potential niche businesses, buying them and unlocking value without destroying what made them successful in the first place. There's no messy integration nightmare. Each acquisition keeps operating much as it did before, just with better financial backing and operational support. Think of them as holding companies that slowly but systematically build portfolios of independent businesses. An added benefit of owning a large number of independent companies is diversification, which tends to smooth out cyclicality in earnings. Programmatic acquirers should never be confused with serial acquirers, despite the market often mislabeling them. They couldn't be more different. Programmatic acquirers have essentially industrialized the M&A process, turning what's typically a high-risk strategy into their greatest competitive advantage. Cambridge University researchers call these marathoner acquirers, companies that do frequent, consistent deals while continuously refining their approach. They turn M&A into an art form. So what makes programmatic M&A different? Programmatic M&A is a systematic and continuous process of acquiring multiple smaller independent entities over time. It's characterized by disciplined, repeatable processes for finding, evaluating, and buying companies, with emphasis on smaller, frequent deals that cumulatively create significant value. Here's what's crucial. This entire process stays in-house rather than being outsourced to investment banks or consultants. To understand why, consider the difference between programmatic acquirers and private equity. Private equity operates on short-term speculative thinking. Their playbook is depressingly familiar. Buy a business, strip assets, load it with debt, slash costs to create a temporary profit spike, then flip it before the damage shows. The destruction may be hidden initially, but it's often deep and permanent. Just look at what happened to Toys R Us. Private equity literally killed that business. Programmatic acquirers do the exact opposite. They use permanent capital to buy strong, cash-generating businesses, make them stronger, and hold them forever. No financial engineering, no artificial exit timelines. Their long-term perspective lets them think like genuine owners, not exit-focused investors. This is acquisition as a business, which explains why the entire process must be managed internally. Nicholas Enmark, CFO of Momentum Group, puts it neatly. The acquisition process is not just a process for closing the transaction. It's also the basis for getting to know the company we're acquiring and its people. And that's one important reason why we manage these things in-house and don't outsource them. So as investors, why should you and I be interested in investing in programmatic acquirers? The track records of the best programmatic acquirers are simply stunning. Constellation Software has completed over 900 acquisitions of niche software companies, driving stock appreciation of over 37,500% since its 2006 IPO. That's a 37% compound annual growth rate sustained for 2 decades. Danaher Corporation has acquired over 400 businesses, while compounding returns at 12% annually for 35 years straight. They use something called the Danaher Business System, DBS, that has helped them generate billions in free cash flow with consistent double-digit returns on invested capital. The Swedish players are equally impressive. Lagercrantz has compounded at 23% annually for 25 years. These companies consistently crush market returns while building genuinely sustainable businesses. So for investors, programmatic acquirers offer several unique advantages. The first is multiple arbitrage. So you get exposure to portfolios of private companies that typically trade at lower valuations than public companies. So when these businesses get rolled into publicly traded holding companies with premium valuations, you benefit from immediate value creation. The second is built-in diversification. Own one programmatic acquirer and you're diversified across dozens or hundreds of independent businesses. This creates what Nassim Taleb calls anti-fragility, investments that actually benefit from volatility and uncertainty. The third is professional management without the fees. The best programmatic acquirers outperform most fund managers without charging the crushing 2 and 20 fee structure that destroys long-term returns. So let's look at the strategic framework for programmatic acquirers. Successful programmatic acquirers share several key characteristics. They use permanent capital with truly long-term thinking, achieving high marginal returns on reinvested capital, often 15 to 20% plus, maintaining aggressive reinvestment rates, sometimes over 100% through conservative debt use, demonstrating relentless discipline in their processes, operating dual growth engines, both organic and acquisitive growth, focusing on recurring cash flows, remaining self-financing without constant capital raises, and ensuring high insider ownership for aligned incentives. This really is a niche strategy. Here's something counterintuitive. Successful programmatic acquirers avoid huge competitive markets. Instead, they systematically dominate narrow, overlooked niches where they can establish lasting advantages. They're typically sector agnostic, deliberately avoiding ties to single industries. This makes perfect sense when you understand that their philosophy runs counter to the serial acquirer's roll-up and integration model. Instead, programmatic acquirers understand that forced synergies rarely produce the desired result. Borrowing a metaphor from the book $1 Billion Lessons, it's almost like signing up a string of rock bands with the intention of forming an orchestra. Nicholas Stenberg, CEO of AdTech, explains, "We don't push synergies. If you ask me, the decentralized responsibility is more important than anything else. If we start taking too many decisions top-down, then we will ruin the entire culture." So let's look at the decentralized model. The magic happens through decentralized operations where each acquired company maintains independence while benefiting from being part of a larger organization. Decision-making stays with teams closest to customers, the people who actually understand each business. This offers a stable foundation on which managers and employees have the confidence and resources to continue pursuing excellence in the service of their customers. Since programmatic acquirers are not looking for synergies between acquired businesses, there are no complex integration nightmares. Frederick Carlson, the former CEO of Lifco, now CEO of Rocco, puts it like this. It's really difficult for someone to understand what decentralization is because they've never experienced it. So they ask about synergies all the time. And it's very difficult to tell them we don't care about synergies. If they come, they come. But it's not why we invest in the company. We buy good businesses. Let's take 2 programmatic acquirers with similar top-line revenue, margins, and valuations. Lifco in Sweden and Halma in England. The former, with over 250 acquired companies in its portfolio, has approximately 8 people in its head office. By contrast, the latter, with only 50 portfolio companies, has almost 70 people in its head office. Both claim to run a decentralized playbook, but it becomes clear that decentralization means different things to each. Lifco runs so lean with just 8 people in its head office that it wouldn't have the capacity to centralize its operating model even if it wanted to. Yet Halma clearly needs an army of people in its holding company for a reason. However these companies choose to implement decentralization, most encourage engagement between portfolio companies in the expectation that it will lead to a cross-pollination of ideas and best practices, filtering through to organic growth. They hold periodic meetings where management teams share experiences and learn from each other, but each business drives its own operations and P&L. What kind of companies do programmatic acquirers buy? This is where it gets really interesting. While some programmatic acquirers prefer high-growth companies, many actually prefer cash cows with limited growth prospects. This might sound crazy to growth investors, but there's brilliant logic behind it. Hidden in slow-growing corners of the economy are small, profitable businesses that nobody pays attention to. They're not sexy, and their modest growth won't excite public market investors obsessed with hockey stick growth stories and expanding markets. This invisibility means they're often available at attractive prices because there's little competition to buy them. Unlike flashy companies burning cash to acquire customers, these niche businesses quietly generate substantial profits while staying completely under the radar. These businesses typically provide critical products or services in specialized markets. They're capital light, face limited competition, have minimal regulatory issues, and most importantly, they're durable cash-generating machines. Here's where the magic happens. These standalone businesses often have no way to reinvest their cash productively, so owners typically extract money for lifestyle purposes while the business stagnates. High cash flow, no growth. It's important to note that most businesses are not operated by business people. A talented engineer or software developer may have stumbled across an opportunity to set up a business many years ago, but he will always be an engineer or a software developer. That's his passion and where his expertise lies. You can't teach a shark to fly or an eagle to swim. We all have strengths and weaknesses. Even if the original founder is no longer running the business, someone else may have ascended the corporate ladder based on their excellence in production, sales, or their political acumen. In both scenarios, the people leading the business are unlikely to excel at business administration and capital allocation. So this situation presents an opportunity for certain types of programmatic acquirers to step in. Jürgen Weich, the CEO of Lagercrantz, explains what we bring to the table is really 2 things. It's a structure and it's energy. We find companies that have been sort of complacent a bit and they need new energy. So we add energy and we add structure. This explains where programmatic acquirers add value. They acquire portfolios of these steady businesses, harvest the cash flows, and redeploy capital where it can earn the highest returns, whether that's new acquisitions or organic growth at other portfolio companies with better prospects. Programmatic acquirers are not buying a company because of the product that it produces. They're acquiring predictable cash flows. Larry Mendelsohn, the CEO of HEICO, explained it like this. We're not merely an aerospace company, but rather a vehicle that generates strong cash flow through aerospace parts and technology. The key is cash flows. This creates the flywheel effect that drives incredible compounded returns. Capital doesn't have to stay where it was created. It goes where it can be used most productively. While operations stay decentralized, holding companies retain control over 2 critical areas: future acquisitions and capital allocation. This creates the powerful flywheel. Steady cash from stable businesses gets redeployed to fuel growth across the organization. This is the essence of acquisition as a business. Since it's all about durable cash flows, programmatic acquirers tend to prefer product companies over service businesses because they're less key person dependent. Products are more scalable and resilient because services too often depend on specific employee relationships. Most programmatic acquirers operate in the B2B space, business to business, by supplying machinery, components, or processes integrated into a far larger final product or service. As a result, they often go unnoticed by the general public, but become mission critical to their customers. By flying under the radar, they attract little or no competition and are able to maintain pricing power and high gross margins. These factors result in recurring revenue streams and attractive cash conversion. Imagine a company that provides vertical software specifically designed to support the daily operations of a dental practice. Its product handles everything from securely storing and retrieving patient records, treatment plans, x-rays, and diagnostic results, to managing online bookings, calendars, and automated appointment reminders. It also streamlines invoicing, payment plans, insurance checks, and often integrates seamlessly with local health service infrastructure. For dentists, this software becomes the invisible backbone of their practice, essential but rarely noticed by patients. The value lies not in flashy innovation, but in reliability. If it works, there's no reason to change it. And because switching systems would be deeply disruptive and costly, users tend to stay for the long haul, creating exceptionally high recurring revenue. This setup demands little in terms of maintenance capex or ongoing product development. It's not about staying cutting edge, just about staying dependable. That makes it a capital-light, sticky business model. For a programmatic acquirer, it's exactly the kind of asset that fits the playbook. So let's move on to think about deal making and how these businesses are acquired. Target companies are typically valued in the tens of millions, a perfect sweet spot. They're too large for individuals or family offices to buy, but too small for big private equity firms to bother with. Limited competition opens doors to attractively priced deals. But how does it work on the sell side? Here's what makes the value proposition so compelling for business owners. Their company represents their life's work, relationships with loyal customers, and bonds with long-term employees. These businesses typically have strong cultures where people are genuinely passionate about their work and all stakeholders. When contemplating retirement, these founders care more about continuity and finding buyers with integrity than achieving the absolute highest price. They don't want to betray the customers and employees who made their success possible. This explains why these people don't sell to private equity firms. They aren't interested in auctioning their business to the highest bidder via a third-party broker only to see it being restructured and asset stripped. They want to find the best home for their business to thrive long-term with minimal disruption. Ideally, the founder will want to retain a small stake rather than selling out completely. In this way, he can benefit from the capital growth delivered by the new owners, in addition to landing an immediate cash windfall from selling a large part of his equity. This will also influence his choice of buyer. It means that high-quality programmatic acquirers are often not competing on price, but on integrity. This is how they obtain the target company at an attractive valuation. Being a programmatic acquirer requires discipline. Making acquisitions a business model is incredibly difficult. Many try, but most fail. Those who succeed achieve spectacular results. Every successful programmatic acquirer has a very specific playbook and sticks to it religiously. Constellation Software, Lifco, Lagerkrantz, each has its own methodology. This discipline arguably explains their success. Find what works and don't deviate regardless of external pressures. This makes sense because compounding is the cumulative result of multiple capital allocation decisions. Why make life difficult by constantly moving the goalposts? That's how you build long-term value, slow and steady. The importance of discipline becomes crystal clear when you look at what happens when successful acquirers deviate from proven formulas. Judges Scientific provides a perfect cautionary tale. This UK company has delivered 22% returns on incremental capital for 20 years by targeting small, high-margin, niche instrumentation manufacturers. CEO David Sickerell built a reputation for disciplined capital allocation, typically paying 4 to 6 times EBIT for predictable, product-led businesses. Then, in May 2022, Judges Scientific broke its own rules, not once, but 4 times. First, the £80 million acquisition of Geotech was larger than all their previous 20 years of acquisitions combined, so they were betting the farm to accelerate growth. Second, it marked their first major move into service-driven revenue, with Geotech deriving 30 to 40% of sales from core scanning services and expedition support, taking them outside their circle of competence. Third, at a cost of 7 times EBIT, they were exceeding their long-term target acquisition multiples. Finally, rather than producing recurring revenues with no customer concentration risk, Geotech generates lumpy, unpredictable revenues, vulnerable to the decisions of a single customer. The deal's rationale appeared sound at the outset. Geotech's leadership in multiple sensor core scanning technology dovetailed with Judge's expertise in precision instruments, and the service component promised to smooth out cyclicality in equipment sales. Yet cracks soon appeared. Revenues dived and the share price collapsed by 50%, reflecting growing concerns that the deviation from its historically successful playbook was a strategic misstep. Management defends its actions, claiming that Geotech's technology remains best in class, and its service revenue, if scaled, could eventually deliver the promised diversification. For now, the burden of proof rests squarely on management, and patience among investors is wearing thin. As the Judges Scientific case study shows, it's never wise to force growth. This principle applies to the funding of acquisitions also. The financial structure of the acquisition will have a huge bearing on the outcome. Ultimately, it's all about being able to scale by redeploying cash flows into growth initiatives, including more cash generative acquisitions. This makes incremental returns on capital and the rate of reinvestment key factors in the success that the programmatic acquirer enjoys. Being tax deductible and enabling the reinvestment of more than 100% of earnings in growth, the conservative use of debt is eminently sensible. But excessive leverage and equity issuance to finance acquisitions should be avoided. This almost certainly explains why successful programmatic acquirers tend not to make oversized acquisitions. Trouble occurs when acquirers attempt to force growth. Brown & Brown, an acquirer operating in the insurance industry, is a case in point. It recently completed the acquisition of Accession Risk Management Group, valued at approximately $9.8 billion, intended to strengthen its capabilities in niche markets. Yet integration is proving challenging on this scale. To fund the acquisition, Brown & Brown undertook a significant capital raise, including a dilutive $4 billion common stock offering and a multi-tranche bond issuance impacting its balance sheet. This new debt burden could prove problematic in rising rate environments, while increased financing costs will eat into earnings. After taking dilution into account, it remains to be seen if this acquisition will be accretive on a per-share basis. Once again, deviating from the playbook and rushing growth appears to be a significant management misstep. Compare this to Constellation Software, which primarily uses massive free cash flow plus conservative debt to fund acquisitions. Equity raises are extremely rare and only used for truly strategic purposes. This discipline has enabled decades of exceptional returns without meaningful dilution. Similarly, Swedish acquirers Lifco and Adtech fund deals through robust cash flows with conservative debt, rarely using equity. Their focus is on improving the profitability of the business they buy, which in turn generates more cash flow to fund future deals, creating a powerful compounding effect. As with all investments, balance sheet discipline is so important. How should we evaluate programmatic acquirers? Several patterns run through long-term winners, creating useful frameworks for identifying future opportunities. Making acquisitions a sustainable business model is no easy feat, and past performance is no guarantee of future success. Simply betting on historical winners may not work, because many now trade at stretched valuations due to their popularity. Even if they continue performing well, there's limited upside potential with significant downside risk if multiples contract. As Judges Scientific demonstrated, even successful acquirers can experience sudden reversals. Success requires continued flawless execution, but as companies grow larger, the pace of acquisitions must accelerate to maintain growth rates. This raises legitimate questions. Does scale act as a drag on performance? Will they be able to find enough companies to acquire? Does forcing acquisitions to maintain growth sacrifice the discipline that created past success? So let's first think about, are there enough companies to acquire? The answer here is absolutely yes. In Europe, 99.8% of companies, that's about 23.5 million businesses, have fewer than 250 employees. And 94% of those are independently owned by founders and families. The nature of capitalism means that new companies are coming into existence all the time, and every company needs a succession plan, so the runway for programmatic acquirers is essentially limitless. The real question is operational and logistical. Is there a limit to the number of acquisitions a programmatic acquirer can make in any given year? Young, small acquirers might need only 1 or 2 deals annually to impact results meaningfully, while established players are completing 2 or 3 each week. How might this affect their relative performance over the next decade? Consider Berkshire Hathaway, which sits on $350 billion in cash. Warren Buffett has explicitly stated there remain only a handful of companies in this country capable of truly moving the needle at Berkshire Hathaway, and they have been endlessly picked over by us and by others. Some we can value, some we can't, and if we can, they have to be attractively priced. This is what makes the Constellation Software model so remarkable. Despite a market cap exceeding 100 billion Canadian dollars, they don't chase large acquisitions. Instead, they religiously stick to their playbook of acquiring small, vertical software businesses, which means having to complete an ever-increasing number of deals simply to move the needle. Constellation now completes about 130 acquisitions annually. With 220 working days in a year, that's more than 1 deal every other business day. It's mind-boggling, but this is what they do exceptionally well. Small, bolt-on acquisitions rather than betting everything on huge deals. They achieve this with about 15 people at their head office, explaining why decentralization isn't just preferable for them, but absolutely necessary. Imagine trying to integrate 130 companies annually with only 15 people in management. It's simply impossible. So each company it acquires operates independently. So how do they do it? Constellation has built probably the most comprehensive database of privately owned vertical software businesses globally. Rather than waiting for opportunities, they proactively reach out, establish contact, and patiently build relationships over time. The goal is being top of mind when founders decide to sell. To balance the story, Constellation's Q2 2025 results showed that it spent $602 million on acquisitions in the first half of this year. That's about half the $1.2 billion deployed during the same period in 2024. This slowdown could suggest the company is finding it more difficult to put capital to work, or perhaps even approaching its growth limits. It's a development worth keeping an eye on. At the opposite end of the spectrum, Lifco sources everything through third-party introductions and has no interest in businesses that aren't actively for sale. This efficiency-focused, broker-driven model has also delivered strong results. It just goes to show there is no right or wrong approach. Each programmatic acquirer seems to have found a recipe it's happy with and which works. And as the old adage goes, if it ain't broke, don't fix it. The difference in approach may also have something to do with the underlying business model. Constellation Software is happy buying companies that don't grow, but simply continue to churn out cash, helping to fuel its acquisition machine. It grows big by staying small scale. Mark Leonard, the CEO of Constellation Software, explains that our business units rarely get large. I believe that these business units are small for a reason, that the advantages of being agile and tight far outweigh economies of scale. I'm looking for ways of achieving scale elsewhere. When it comes to great small businesses, why not own a bunch of them through a holding company? In stark contrast, companies such as Lifco seek to acquire companies with high potential for organic growth. So there really is no one-size-fits-all model. It's more a case of horses for courses. It's so important to stress that management makes a key difference. Management quality, especially at the CEO level, represents the most critical differentiating factor. Hamilton Helmer identifies cornered resource as one of his 7 powers. This is an asset that competitors can't replicate. Leaders like Mark Leonard at Constellation Software and Warren Buffett at Berkshire Hathaway exemplify this perfectly. For programmatic acquirers, sustained success requires rare expertise in consistently executing value-creating deals. The ability to identify, structure, and integrate acquisitions in a systematically accretive manner represents a specialized skill set that few management teams possess. So when investing in a programmatic acquirer, be mindful that they are not all the same in terms of operating model, management quality, ability to grow, or risk profile. Success depends on identifying managers with proven track records, aligned incentives, and a genuine understanding of value creation, rather than just chasing growth. Companies that treat acquisitions as capital allocation decisions requiring investor-like thinking and rigorous return requirements are more likely to succeed than those merely chasing growth for its own sake. It isn't about empire building, it's about optimizing risk-adjusted returns on capital. Sometimes less is more. Halma, the UK programmatic acquirer, often extracts working capital from low-return operations and redeploys it more productively elsewhere. David Barber, the former CEO and chairman of the board at Halma, explains that the route we adopted at Halma as long-term operators was to focus on mix. In broad terms, simply doing less of anything that gave returns below the target level and doing more of what gave returns above this level produced the results we were looking for. It sounds simplistic, he said, but given time, the cumulative effect of this can be massive, even in a large group. Constellation Software readily buys companies needing restructuring if there's a clear path to clean cash flow generation and it's at the right price. When companies are underperforming, they're often available at significant discounts. Constellation will buy them and perform surgery, effectively trimming the fat, and what emerges is a leaner, better business in terms of unit economics. Revenues will dip, but margins and returns on capital will increase. Less is more. If the acquisition price is right, why not? At the 1998 Berkshire Hathaway shareholder meeting, Buffett nailed it when he said the worst business of all is one that grows a lot, where it's forced to grow to stay in the game, and where you're reinvesting capital at very low rates of return. Programmatic acquirers make sure they don't do that. In all of these companies, whether it's Halma, Constellation Software, or Berkshire Hathaway, if a wholly owned subsidiary doesn't have the opportunity to meet the hurdle rate for reinvestment, the cash flow is simply swept up and put to more productive use elsewhere in the group. When looking at programmatic acquirers, it's very important to understand their accounting practices. While many programmatic acquirers claim similar strategies, their financial reporting often differs dramatically, making comparisons extremely challenging. Remember, these aren't companies in the same industrial sectors. They're businesses with similar playbooks operating in different economic niches with vastly different unit economics. If this doesn't make comparison difficult enough, accounting differences compound the analytical challenge. Some buy companies outright, clean and simple. Others take majority stakes in businesses owning just over 50%. This latter approach creates analytical nightmares for investors, resulting in sprawling subsidiary networks that make holding company financials particularly tricky. Under equity accounting, the holding company reports 100% of subsidiary earnings, despite barely owning half of these businesses. This means attractive EBITDA figures aren't fully theirs, throwing off valuation metrics like enterprise value to EBITDA, and making acquirers look cheaper than they really are. It also distorts the debt to EBITDA ratio, since most debt sits at the holding company level, while the EBITDA includes businesses that they don't fully own. Acquirers that find themselves in the B2B distribution business build a reputation for being a dependable partner, able to supply customer needs on demand. But this model, sometimes referred to as always in stock, requires a great deal of working capital being tied up in inventory. Needless to say, this acts as a drag on performance. In stark contrast, acquirers in the vertical software space have no such problems. Inventory? What inventory? This explains Constellation Software's exceptional performance. Through its myriad of software companies, it often enjoys negative working capital, collecting subscriptions up front while providing services over time subsequently. Customers actually finance its growth with no associated financing cost. The importance of the working capital dynamic explains why many of the best performing programmatic acquirers are laser focused on efficiency benchmarked against working capital. Next, we need to consider the intangible asset accounting. Post-acquisition, assets and liabilities should be allocated line by line through purchase price allocations. Each line item is then managed in accordance with the relevant accounting standards. So, property, plant and equipment is carried at cost less depreciation. Inventory is valued at the lower of cost and net realisable value. Any excess paid over the fair value of the identifiable net assets is recognised as goodwill. There's nothing unusual here. This is all basic accounting practice. But approaches to dealing with intangible assets like customer relationships, patents, and brand values differ significantly among acquirers. Some allocate heavily to goodwill, others assign substantial amounts to specific intangible asset line items. This creates real differences most investors underappreciate. Allocating heavily to goodwill is not only inaccurate from an accounting perspective, but it's a far riskier strategy. The acquirer is essentially saying we paid extra above net asset value because we believe this business will perform better in the future. So it implies a huge bet on growth, on synergies and operational improvements beyond the existing cash flows of the acquired business. While allocated intangible assets can be amortized steadily over time, lumping everything into goodwill will mean that if growth or synergies don't materialize as expected, goodwill impairments will create large, sudden hits to earnings, making financial results more unpredictable. In the era of cheap money from 2008 to 2022, substantial goodwill could be justified through favourable discount rates. With rates now normalised, impairment tests are stricter, elevating these risks. These contrasting approaches reveal fundamental differences in risk tolerance, asset selection, and long-term strategy. The coming years will separate disciplined acquirers of durable cash flows from those relying on financial engineering and benign capital conditions. For smaller acquirers with fewer companies, each acquisition carries more weight, and single underperformers can dramatically impact results. Stronger acquirers like Lifco and Constellation Software consolidate smaller businesses into larger platforms, allowing strong performers to offset weak ones. Once again, this explains why it's unwise to chase large-scale acquisitions as a programmatic acquirer. Some programmatic acquirers, particularly the smaller ones, such as Technion, have been known to aggressively allocate all intangible assets to goodwill. In addition to the issues already raised, this artificially inflates short-term earnings at the expense of tax efficiencies due to the reduction of tax-deductible depreciation and amortization. Why would a company prioritise the appearance of earnings over tax efficiency? Are they seeking to massage their share price higher? I'll leave you to formulate your own opinion, but it does raise the question of why auditors acquiesce in this practice of accounting which is so difficult to defend. Investors should focus on companies that create genuine value through acquisitions, rather than those relying primarily on multiple arbitrage or accounting optimization. Companies like Lifco and Constellation Software use more systematic approaches. Lifco typically allocates 66% to goodwill, while ultra-disciplined Constellation allocates less than 20%. These differences matter significantly and compound over time as acquisition activity increases. This is made more complicated because almost all acquisitions have elements of deferred consideration and contingent consideration attached to earn-out provisions as part of the transaction, so the true cost and allocation of intangibles is not known until some later date. All this means goodwill allocation approaches significantly impact earnings multiples, making price-to-earnings comparisons potentially misleading for programmatic acquirers. When analysing these companies, we don't look at EBITDA, we look at EBITA when comparing these companies in order to remove these distortions by removing the noise of both tax and amortization. Depreciation shouldn't be added back because it's a real expense of the business, a proxy for maintenance capex. Staying with the topic of balance sheet accounting and goodwill, under accounting standards, there is no specific revaluation of acquired portfolio companies, despite their earnings power often increasing when in the ownership of the programmatic acquirer. This leads to a significant understatement of the real asset value of the holding company, which becomes more pronounced over time. It distorts metrics such as return on assets and on equity, which tend to improve sequentially based on an unreliable denominator. This has two consequences. First, it becomes increasingly difficult for outsiders to track true performance, creating space for accounting creativity that can mask operational weaknesses. Second, the older and more established programmatic acquirers ought to have far higher return metrics than the new kids on the block, which makes side-by-side comparisons meaningless. It's far better to focus on the marginal returns achieved on incremental capital. So when investing in programmatic acquirers, where do we find value today? Long-term success comes not from clever accounting, but from buying quality businesses at sensible prices. Few models prove this better than acquisition as a business. Mark Leonard at Constellation Software turned $25 million of seed capital into over $60 billion of value just over 2 decades later by systematically acquiring niche businesses. But when operational success creates such shareholder value, everyone wants in, driving valuations to levels where companies no longer look attractive. True opportunities often surface in two places, during market dislocations or with younger acquirers still flying under the radar. Europe has become especially fertile ground for programmatic acquirers. Multiples of target companies are lower, competition is lighter, and markets remain fragmented by culture, regulation, and language. These barriers deter many, but reward those with local expertise. And it's the reason that Constellation Software created its spin-off, Topicus, to seize regional opportunities in Europe. Topicus is now well known, but there are many other that are lesser well known but equally worthy of investor attention. The challenge is in finding these hidden gems which may still offer compelling entry points for patient investors. Over coming weeks and months, I'll be publishing deep dives on specific names, examining several of these emerging opportunities in detail, analysing their specific strategies, management quality, financial structures, and long-term value creation potential. So stay tuned and subscribe if you haven't done so already.
We really hope that you enjoyed today's podcast, but we really only scratched the surface. If you want to explore any of the themes discussed in more detail, see the show notes or visit us at rockandturner.substack.com. Oh, one more thing. Be sure to like the episode, share it with others, and save it to your favorites so that you don't miss future episodes. Until next time, we wish you every success with your investments.